So you'd rather do a bunch of watch a bunch of
Tough question.
Oh, no.
Just too nice to each other.
Okay, let's get started. The first thing is, if you haven't picked up, you can pick up the break. This is a hard copy of the case that we're doing on Thursday. Global relative value in the early 21st century. This is a case in asset management strategy. Well, it's mainly focused on fixed income. It has like broader implications in terms of all asset classes. And what I'd like to do is to assign the groups to different characters in the case. So I'm going to do that right now. So Sigma Asset Management is going to be Asia. UTC is going to be Europe. Looney Tunes, Americas. First Years Asset Managers, Quant. Fat Tail Dragon Asset Management, Econ. BSD, Marketing. Sharp Minds, CIO. And Global Strategic Management, CTO. And so that doesn't mean that you just look at that part of the case, you have to look at the whole case. Everybody should be looking at their, about half the time we'll talk about these functional areas, and the other half of the time we'll talk about the overall. Okay, so, but I will be calling upon each of the areas to basically contribute during the discussion on Thursday. Okay? This is an important case, so be sure to read it all. There's a lot of data at the beginning of it that you might already know, so you can just like flip through that quickly. But the written stuff is very important. Okay? I've also handed out a hard copy of some of the stuff that I put on the overhead last Thursday. Okay? And webcast students, you already got a copy of this by email. Okay, let me start off. We've got a lot of ground to cover today because basically the plan is that we need to figure out kind of this asset pricing, attribute, asset allocation stuff today. We go to strategy on Thursday, and then we flip to stock selection next Monday. Okay, so we did kind of a lot of technical stuff on Thursday. I need to go through that again. Carefully, I've got a presentation that you might have printed out that I emailed or put on the iDrive at least. We'll go through this again, try to get as many people on board as possible. This is important stuff to understand. The linkages between asset allocation, investment management, and asset pricing, which is really just risk. That's what it's all about, risk. Okay, so we can call it asset pricing models, but asset pricing models are simply a way to determine what risk is. Okay? And we assign, obviously, a reward to the risk as a real risk factor. And so that's an important point, that you can actually estimate betas for many different securities against whatever factor, but it's only truly a risk factor if that beta is rewarded. So if high beta means high reward, and low beta means low reward, then that's a risk factor. Okay? So just because you get a beta doesn't mean it's necessarily rewarded. It's got to be a relation. We'll go through that stuff today. But before we actually do that, I wanted to, I promised I would compile the results for assignment number 2 of the strategic asset allocation assignment in terms of your views of the market. And they are up here. So these are from last year. The 5-year returns as of January 31st, 2000. And let me just show you what happened. So the median return here is about 10%. And this year, it's knocked down by 3. So expected annual return. So just remember, I'm just counting the numbers here. It's not percentage frequency, so that's why the graph looks a little different. But you can see a definite shift down in terms of forecasted returns. And that's both of them together. So that's last year, this year. So expected returns over the 5-year horizon are a little less. Okay? And somebody asked me what I actually thought, and I'm not supposed to be giving forecasts in the class due to litigation history. And that's a real factor, actually. But I will say that my baseline for 5-year S&P premium, so over above the bill, is 5%. That's what I'm using in my models. 5% annual return over and above the risk-free rate, which is within the ballpark of what you're forecasting. Maybe you're a little lower than that, probably because of what happened with assignment number 2. We're getting these negative return forecasts. Now, I assume that assignment number 3 is also in. There were some problems loading it up on the iDirect because we ran out of space. Yeah, and don't email these 10 megabyte files to me. Just crush my inbox. We can free up some space to get them all there. And I'll do kind of the same thing. What I'll do is this time go through your models and actually kind of summarize the variables that we found were useful for prediction and ones that were not useful. And then I'll distribute that to the class. Okay, so we kind of share information about predictability. Okay. Yeah, so in terms of work, we've got the case on Thursday. We've got assignment number 4, if you choose to do it. Coming up soon. All right. Any other questions? Or any questions? Okay. Good. Well, let's. What I want to do is to go through this. This predictability versus explanatory types of models in asset management. Okay, so I'm just going to basically go through a number of slides and try to make sure that as many people are on board as possible. Okay, so let's start off by looking at a simple predictive model. This is exactly the type of model that you were looking at in assignment number 3. Take the return, and to make things simple, let's just use the little r as an excess return. It doesn't have to be, but that might help our notation a little bit. And this is just an example. That's why I've got example here, where we regress the return on the lag yield spread. Okay, there's a residual. Notice the timing here, t minus 1 versus t. Okay, the residuals are E, and these models have low R squareds, as I'm sure you've noticed from your assignment number 3. So this is a purely predictive model. Okay, so let's call that model 1. And that's the model that you're using in assignment number 3. And that's the type of model that you also use for your strategic long-term forecasting in assignment number 2. This is a factor model. It's explanatory, and notice that the timing is different. Time t and time t. So we're explaining what happens in the market. So if the factor is, let's say, the world return, the world equity return, if the world equity return moves a certain amount on a particular day, then this model tells us what to expect the individual equity return to move. Okay, and that's really important. It's what you expect. It's not exact. This is just an estimated relation. So if the beta is 1, that means that we expect the, let's say if it's an excess return, it to go up by 10%. So it would be 1-to-1 with the excess returns. Okay? If it's 2, then it's 20%. And that's what we expect. And this gives us a measure of the contemporaneous relation between the factors and the returns. And indeed, I kind of like to use the word factor for these explanatory models. And for the predictive models, I like to call the variables instruments. Okay, so that kind of minimizes the confusion. As soon as you start talking about factors in a predictive model, that confuses me. Because usually factors are contemporaneous. Okay, so this is a contemporaneous relationship. This is also just an example because I've got only one beta. Okay? This could be 5 betas. It could be 40. Just depends on the model. Okay. So the beta, in terms of the terminology, the beta is sometimes called a factor loading, sensitivity, or just plain old beta. Okay? And it's kind of like, as I said, kind of like an elasticity in a way. So given a change in this factor, what do you expect to happen for the individual securities? Now, this is not an asset pricing model. This is simply called a factor model. It's a statistical model that relates the movement in the factors to the movement in the underlying assets. And this is what we call a time series model. So you might estimate this over 5 years of monthly data on the return, regressed against 5 years of monthly data on the factor. We get a beta. Okay. Now, what asset pricing models do is they estimate these models to get the betas for many different securities. And you collect the betas, and what you hope to see is a relationship between the betas and the expected returns. So in this case, the way we specified it, and suppose that this single factor is the Morgan Stanley Capital International World Index, that the higher beta securities have got higher expected returns than the lower beta securities. So this represents about a dozen time series regressions to get the betas. And then what I've done is I've correlated the betas, or the regression coefficients, with the returns to see if there's a relation. So this is what an asset pricing model does. The main bite in an asset pricing model is that it says, well, this beta has a particular reward to it. And in this particular graph, there's a positive reward for taking on additional risk. So an asset pricing model actually, it determines the betas that actually qualify as risk. That's what it does. Okay, so again, this is a cross-sectional relationship that's relating the beta or the factor loadings for different assets to the expected returns. And in this case, it's a reasonably good fit that I've drawn up. Okay. Now, we talked a little bit on Thursday about whether it's reasonable to have the betas fixed through time. And it turns out that if we assume that betas are constant, we don't get a very good fit. And this graph just demonstrates approximately what you get. This is not a very good regression line. Indeed, the way that I've drawn it, it has an R-squared of 0. And what does that mean? It just means for any level of beta, you can't say anything about whether the expected return is higher or lower. Okay, so your assessment of the expected return for beta of 0.1 is no different than a beta of 1.1. Okay, so it's flat, no significant relation. And this is assuming that the betas are fixed through time. Now, if you allow the betas to change dynamically through time, then the asset pricing model does a better job. And I mentioned that in some of my papers, that's exactly what I found. So my World Price of Covariance Risk in Journal of Finance 1991 was a paper that allowed for dynamic kind of risk through time. And when you allowed for that, when you allowed for this additional flexibility, the capital asset pricing model did some better, a little better. Okay? Now, this is only an example, as I said. This is a single factor. And it's kind of naive to think that a single factor is going to capture all of the dimensions of risk. But for illustration purposes, at least, we can see that we can get some mileage out of a single factor. Now, how much explanatory power can you actually hope to get? Equity returns are very difficult to explain. Very difficult. So the cross-sectional explanatory power of these models, when you look at the betas against the CAPM or some other model, sort of cross-sectional explanatory power, we're talking in around 30 to 35%. And you've done really well. Okay. Now, I show you that this scatter looks a little better if we allow for the risk to shift through time. And I guess the logical question is, well, how do we actually implement that? Because it is appealing somewhat to have what I call a dynamic risk function. And on my website, you'll see some sector data where I've got dynamic sort of betas through time. And so really what you want, if you're doing any project evaluation or investment analysis, you want to know what the risk is going forward, not necessarily what it was in the past. Okay, so there's a number of different ways to do this, and let me kind of go through them. Model A is very simple. Estimate a 5-year rolling window. Okay, so think of it as using 60 monthly observations, estimate your beta, and then just shift forward 1 month in time. So you pick up a new observation and you drop an old one. And there's 58 months that are common in your regression. And then just keep on doing this rolling style regression. Some of you did that for assignment number 3 for the correlation analysis. Okay, so that's a simple way to get the betas to change through time. So using kind of a 5-year sample and kind of rolling it through time. Okay. And that model is actually not a bad model. But it does use the past. All of these data use the past. But this type of model actually gives a little more weight to the most recent data. And you can see patterns in the data. So you can see perhaps that the beta is trending down. And then you could extrapolate from that. Model B is a Garch-like model. So when we estimate Garch with multiple equations, multiple assets, then it delivers not just the volatilities, but the covariances. And if we've got the forecasted covariances and the forecasted variances, then it's a simple matter of putting it together to get the betas. And there's some research out there that actually compares Model B to Model A. Model A is a lot easier to do. Model B, once you start using multiple assets in a Garch framework, it can be very difficult to estimate the parameters. Indeed, a number of you found this weekend that just for one asset, it's sometimes difficult to get those parameters estimated, if they're even possible to estimate. With the usual Garch model, for a single asset, you have a very few parameters. Once we start adding multiple assets, the number of parameters increases, and it becomes more difficult to estimate. Okay, model C is the model that I like to pursue today. And I call it a dynamic linear factor model. And what I'm going to do is to make an assumption as to how the beta changes through time. Okay, so let me write this down. The first equation just says that RIT is related to some factor, F. It's the usual beta regression. So give me some time series data, let's say over 30 years, and I can estimate this. And it's best to think of the beta as the average sensitivity over those 30 years. Or if the factor moves by a certain amount, then on average, the return should respond by the value of the beta. Okay, so this is an average relation. It holds fixed the beta through time. Okay, and it's a single factor specification. Now what I'm going to do is the following. I'm going to assume that the beta is a function of something else. So I'm going to assume, and this is purely an example, I'm going to assume that the beta, let's say, is a function of the lagged level of the interest rate. Let's say the 90-day Treasury bill rate. And I'm going to specify a beta function. Notice there's a t subscript on it now. It's an exact function, so beta is going to equal C0 plus C1 I t minus 1. And what I'm going to do is substitute this for the usual beta. So I'm going to take this and just dump it right into this equation, right here. That's it. So this is a beta that's changing through time with the lag value of the interest rate. And if it's positive, it simply means that the risk is increasing if the interest rate increases. I'm going to substitute that in and see what happens. So let's actually do that. So the first equation, all I've done is put my definition of beta right here. So that was the beta for I. Substituted it in. The next equation, I'm just going to rewrite that to get rid of the brackets. Okay. And when you do that, notice the following. This kind of looks like what we started with. Right? The C0I looks like our initial beta. But we've got something else here now. We got a second coefficient multiplied by IT minus 1 times FT. So our original regression was a simple bivariate regression where we regressed the returns on the factor, got an intercept and a slope. Now what we're going to do is to regress on two variables. The returns on the factor, and then this extra variable that we created by multiplying the factor times the lag value of the interest rate. Okay, so think of this as just multiplying two variables together, and that's going to be an extra variable that's going to become a multiple regression. And now we're going to get an intercept and two slopes, C0 and C1. So this is actually pretty easy to do. Don't need any heavy-duty econometrics to do this. Instead of just a simple regression, we're going to create a new variable, which is going to be the interaction between the interest rate and the factor. rewrite it. This is the new regression. We're going to estimate 3 coefficients. And what happens if we estimate this regression and this new coefficient, the C1, what if that's equal to 0? What does that mean? Yeah, it's just back to the old model. The old model says the beta is constant. Well, there's the beta, C0. Okay, it's got an I subscript because this is for firm I. So it says the beta is constant, or another interpretation is that we specified the wrong model for beta. That maybe the beta isn't constant, but we got the wrong variable. Okay? Maybe it's better to say that there's no dynamics in the beta that are related to the lagged interest rate in this particular formulation. Okay? But let's actually suppose that this C1 is significant. Then what do we get? Well, we get a dynamic beta. So with the C1 and the C0, we recover our hypothesized function. Okay, so now what we can do, you can think of actually plotting the beta through time as a result of this equation being estimated. So we estimate the C0, we estimate the C1, we've got the lagged interest rate, then we can generate, think of generating a graph with the fitted values from that, and that tells you something about the beta changing through time. Indeed, in assignment number 4, you're actually asked to do this. Okay, so this is a very simple way of getting the beta to change through time. Okay. There's other things that we can do that we've all already mentioned, and let me kind of go to one of those things. So off the prepared material. So we talked about maybe the beta is different in recessions versus expansions. So how would you actually get that into the regression? Well, I could write out a regression of RIT equals alpha I plus beta I, and let's put an R subscript on this, times FT plus beta E for expansion FT. And what I'm actually going to do here seems like the same variable, right? But what I'm going to do is the following. I'm going to create a dummy variable, dt, and that's going to come on for recession, and another dummy variable, de, and that's going to come on for expansion. There's also an error here. Okay. And it's very similar to the model that I just wrote up here. So all we're doing is, you can think of this in a very simple way. It's just sampling all the data during a recession and calculating the beta, sampling all the data during expansion and calculating the beta. And you get 2 slopes. So this is a very simple type of function. And what you can think of it as is just simply kind of like a step, depending upon where you are in the business cycle. Okay? So you can create these dummy variables to take care, and this is a very simple dynamic beta. It just takes on 2 values. It's binary, either recession or expansion. Or we could call this yield curve positive, yield curve negative. we get 2 betas. So it just jumps as soon as you go positive to negative. Okay? Does everybody see that? That the beta, if we plotted the beta function here, it would just simply jump. So if we plotted, if this was this is beta, and let's say we use the yield curve negative or positive, right? So it's the beta function, and let's say that's 0. So the yield spread here is negative, and yield spread here is positive. Okay, we just created an indicator variable. It might be that the beta function actually looks like this. Up to 0, and then it jumps down like that. A very simple beta changing through time at one particular spot. It jumps. Okay? So it's another way to get a dynamic type of beta. What I'm suggesting is different in that we've now got a function of the beta, which is a function of the interest rate. Okay, so instead of taking a jump like this, we could again draw the beta diagram. And our variable was it minus 1. And what is our beta function going to look like? Any ideas? So remember, the function was bt equals c0 plus c1 it minus 1. Straight line. Exactly. And the line, who knows exactly what it will look like? It depends upon the c0 and the c1, right? So this is against the beta. If we assume the c1 is positive, let's say, then our beta function is going to look like that, straight line. Everybody see that? And just to be clear here as to what I'm talking about, we could also graph the beta through time. So we could graph beta t through time. And that's going to be a different type of graph. It's going to be a time series graph. So it could be, it might look like something like this. Okay? So then basically what we're doing here is we're just generating bt equals c0 plus c1 it minus 1. So whatever the value of it minus 1 is, and it's changing through time, we're just getting our fitted value, and this is the beta function through time. And it might be that if we just estimated a constant beta through time, maybe it looks like this. So this is maybe the beta constant. Okay. Okay, so let's just explore this a little bit more, because dynamic risk is important. And we don't have to just have a function like this, right? It's just an assumption. So we could put other variables here, and we could even make this nonlinear. Right? Suppose that I want some sort of nonlinear function here. So I could add to this, let's say, a square term to make it quadratic. So suppose I said, well, the beta is not linear in the interest rate, it's quadratic. So how would that change the way that I actually do it? Well, let's actually work it out. So now let's say the beta equals C0 plus C1 IT minus 1 plus C2 IT minus 1 squared. There actually could be a logic for actually doing this, because the square is often associated with the volatility. So it's a crude proxy for the volatility. So we're saying, well, the beta is going to change in the level of the interest rate, and is also going to be affected by the volatility of the interest rate. Okay, so again, all we need to do is to write down our factor model, which is alpha plus beta ft. And notice I've suppressed the individual I subscripts here. All I'm going to do is the same thing. Let's substitute this thing into my factor model. And this time I'll skip the step and write out the whole regression. RT equals alpha plus C1 ft plus C2. Do I have that right? C0. Okay. C1 times ft times IT minus 1 plus C2 times ft times IT minus 1 squared. Everybody got that? So this is what we had before. We're estimating 3 coefficients, alpha, C0, and C1. Now we just added one more thing. We're getting C2. And we've created an additional variable, which is the factor multiplied by the square of the interest rate. Are you concerned about things like multicollinearity here? Not necessarily, because these are different variables. Ft appears in all 3, but as soon as you start multiplying it by something, it's a different variable. Okay, so this way we get these 4 coefficients, and again we can generate our beta function, and it might graph our beta now against IT minus 1. Now it might actually look like this. Okay? And how would we test as to whether the quadratic term is actually an important component of the dynamic beta function? What's the test? Well, we got the regression we're estimating, which is RT equals alpha plus C0 ft plus C1 ft times IT minus 1 plus C2 ft times IT minus 1 squared plus some error. So how do we test whether the quadratic is important? C2. Is this coefficient significantly different from 0? That's it. Okay. Now, if we actually graphed it and saw this, likelihood is that it is significant. So this is a way to get betas to change through time. A simple way. And I actually, for this type of analysis, I actually believe that there are more merits in using this kind of economic model than trying to estimate a multivariate Garch process for the betas. Okay? Where I can actually put variables in that I've got a strong reason to think affect the beta. We're looking at an individual firm.
and you're looking at equity betas, what is, I'll ask the question, I know the answer. Think about this, okay, what is kind of like driving the equity beta? So what would be kind of your first choice variable to include in a dynamic beta function? What are kind of like the fundamental determinants of the equity beta?
It's the difference between the prices at any two given points. You're, for example, measuring beta within a day, it's the price difference
Yes.
between any for every minute, or beta across a month. Probably you would take the price difference at the end of the days throughout the month.
Yeah, well, you know, what you're getting at is just like how to measure that beta. And it's true, you actually look up these betas and they can be much different across different services. So what's the best way to actually do it? And there's a lot of them out there. There's like anticipated betas, there's different corrections for infrequent trading. Did you do that type of stuff, like infrequent trading correction on beta? No, where you regress on, basically what you do is regress on the factor and the lag factor, and you get kind of two beta coefficients and add them together and just say that that's the beta. And it takes into account that the stock might not have traded at the end of the day and does a little catch up the next day. Okay, so that's a typical correction. But you know, remember, we're talking the equity beta here. So what might affect the equity beta? Individual firm level. Yes, possibility. Might affect
Company
the,
size.
say it again?
Company size.
The company size, the definite possibility. So we're talking about attributes that could be related to the beta.
Amount of
Right.
leverage that the company has.
Say it again.
Amount of leverage that the company has.
The amount of leverage. That's what I was looking for. Like everything that's been said is valid, possible reason that the beta might change. But what about leverage? Well, you've done this exercise where you go to the beta of the asset and then beta of the equity. You've done that, right? You see what happens when you do different leverage ratios? What happens to the beta of the equity? Yeah, it changes, right? So the risk depends upon the level of leverage. And leverage changes through time. Therefore, the beta changes through time. So it seems to me that, and I actually feel quite strongly about this, that the null hypothesis that we should be starting with is that the beta changes through time. That's our initial position. Now, if somebody wants to go and use a constant beta, then the burden is on them to prove that it's constant. It shouldn't be the reverse. It doesn't make any sense whatsoever. You just leverage alone is enough to drive the risk to change through time. Okay, so kind of where I come at this is from the perspective that risk should be on first principles assumed to be dynamic. Louisa.
When we were unlevering and relevering the betas, we also calculated the unlevered betas of the beta, the underlying assets,
Yes.
beta A. Can we assume that that is constant through time, or we can't assume that that is constant through time?
Good point. So I guess the way, and the question has to do with the beta of the assets that you calculate. Maybe that's constant through time, but the equity beta is flipping all over the place given changing economic conditions and leverage and stuff like that. You know, and indeed, you know, it kind of makes sense that you might have like 80% leverage in good times and not be perceived to be that risky, whereas 80% leverage in a downturn, that could really affect your risk. So it's not just leverage. I don't want to be telling a story of 100% leverage here. Okay? Leverage is a component of risk that's kind of obvious. But there's other stuff that could even interact with the leverage. The question has to do with the beta of the assets. Is it reasonable to assume that the beta of the assets is constant? And I guess my opinion on that is no. Okay? But I think that if we're going to make an assumption, equity beta constant versus asset beta constant, that the better assumption, or a worse assumption, is the equity beta being constant. So I think that the asset beta could be more constant than the equity beta. But again, it evolves through time depending upon economic conditions. So does that make sense? That I think that it's really fundamental. People, if you ask people in the market, is risk constant? Like, nobody's going to agree that risk is constant. Then the question is, what are you going to do about it? Okay, and you'd be surprised the sort of models, the risk kind of control models that are out there. They've got stuff like, exponentially weighted moving averages of past standard deviations and exponentially weighted moving averages of beta even. Okay. But it seems to me, if we're really going to do a good job of risk analysis, that we need to model kind of the fundamental determinants of risk. Okay? And this is a simple framework to actually execute that. It's a framework that you don't need more than a simple regression package to do. So what are the factors that you think are important for beta? And dump them right in the model. Then you've got this model that's got the contemporaneous values interacted with the lag values. Okay? And this is maybe where it gets a little confusing. Because we're thinking model 1 is predictability. Model 2 is explanatory. Yet all of a sudden in model 2, we've got a beta that's being dynamic through time. And we've got lag values in the regression all of a sudden, even though they're interacted with the contemporaneous. So let's try to not confuse these two approaches. The predictive model, model 1, is a pure forecasting model. Okay? What we're doing with model 2 is trying to layer on some economic content in terms of risk. Okay? So let's continue with these slides. I said last lecture that it doesn't make sense to test an asset pricing model with constant betas. And maybe I've got the benefit of hindsight here, because all of the classic tests of asset pricing models basically assume the betas are constant. Okay, beginning with the Black-Jensen-Scholes 1972 classic test of the CAPM. Okay. I will say that Eugene Fama was way ahead of his time in something he published in 1973, where he actually used rolling betas. He never mentioned dynamic risk, but he used rolling betas way back in 1973. Very smart idea that is even used today. Okay? But nevertheless, a lot of the classic tests of these models, where you will basically see a paper, a research paper saying the CAPM is rejected. But really what's being rejected is the CAPM plus this extra assumption that the risk is constant. So you can't really tell. Is it the model that's bad, or is it the assumption that's bad? Okay, so let's kind of review some of the terminology here. Unconditional CAPM. And again, I taught CAPM, you think immediately the Sharp-Lintner one-factor model. This could be a multiple factor CAPM. Okay, so there are multi-beta CAPMs as well as single beta CAPMs. So the unconditional CAPM relates average returns to average risk, fixed beta. And that's what I suggested did not do a very good job of explaining the cross-section of returns. So explaining why one asset has a lower return than another asset. That's what the cross-section really gets at. So unconditional is simply looking at historical averages, the average beta, the average return. The conditional CAPM is something different. It links predicted returns. Okay? So think of it in terms of the following. Assignment number 3, you're predicting returns on, let's say, 5 asset classes. Okay, so you're getting, let's say, 1 month ahead or 1 quarter of ahead predictions in terms of these asset returns. There's no asset pricing model in the background whatsoever when you do this. You're using economic theory to specify some of your variables. You know, like maybe there's persistence in the business cycle, and you're picking up some variables that are capturing that, but there's no betas being estimated. It's a purely predictive regression that you're running. Okay, and you're doing it country by country in isolation. So what the conditional version of the CAPM says, okay, you give me your predictions across different countries, and I'm going to try to explain why those predictions differ across different countries. So why is it that one country has a high expected return, another country has a lower? And the conditional version of the CAPM says, well, let's crank some dynamic beta functions, take a look at the anticipated betas, and see if there's a relationship between the anticipated betas and the forecasted returns. That's what's happening with the conditional model. Okay, so what you're doing in assignment number 3 and assignment number 4 is a purely statistical predictive model. And if you were just estimating explanatory factor models, that is also a purely statistical model. In assignment number 3, assignment number 4, you're trying to explain, well, I shouldn't use that word, trying to predict next period's return. You could be doing another assignment where you're estimating betas, where you're trying to explain the return, given contemporaneous information. Both of those exercises are statistical. The explanatory exercise got high R-squared, 90+%. The predictive exercise got a low R-squared. But the asset pricing model links the different statistical expected returns. That's what it does. Okay, so you could think of the unconditional model as explaining, given the betas that are estimated, that are fixed, trying to explain why some assets have a higher expected return than others. You could think of the conditional model as trying to explain, based upon dynamic risk functions, why predictability, the predicted returns are different in different countries. Okay? It's basically what's happening. So the asset pricing model tells us something about the cross-section of expected returns. In both cases, we're linking either fixed betas or dynamic betas to either the explained returns or the predicted returns. And that's what's going on. Now, there is some extra stuff that we got to figure out. And one thing that's quite interesting for me is to figure out how much of the predictability that we find in assignment number 3 is anticipated given a model of conditional asset pricing. Okay? So remember I said that if we took all of our forecast of returns. We can potentially explain the forecast of returns using an asset pricing model, a conditional asset pricing model. Okay, but we're not going to be able to explain all of it. We're going to be able to explain some of it. And maybe the most interesting part is what you can't explain. And what you can explain has got 3 potential sources. Okay. Let's see if I counted this right. One could be that we just misspecified our asset pricing model. Okay, so we've got a bad model. It doesn't explain the predictability, but it's because we have a bad model. Second, we could have snooped the data to find, 25% R squared that's not real. It's constructed. After I swept through 5,000 stepwise regressions, I found something that's no surprise. The more variables I try, the higher that T ratio is going to go, just by pure chance. So I got 25% R squared, and it's just a lucky consequence of looking at so many variables. The asset pricing model cannot explain these asset class expected returns that have high predictability. They can't explain it because I've snooped the data. Number 3, I can't explain the predictability because, what do you think? Oh, there is. Let's say there is. So I've documented predictability. I can't explain it with my asset pricing theory. Okay, unless I've got the right asset pricing model and I haven't snooped the data. Yes?
Which is because of error. It's just a natural error in your estimate.
That's a possibility, but let's say we discount that possibility. So I've got the right asset pricing theory. I know we're taking a number of leaps of faith here. The right asset pricing theory, I haven't snooped the data, can't explain this predictability with the asset pricing model. So what could it be? Yes?
You haven't considered an important variable.
What's that?
Capture.
Oh, let's say I've got the asset pricing model correct. So I've got the important variables. What you're trying to say is you got the wrong asset pricing model because you missed some important variables. Yes?
Well, you're assuming everybody's going to put the same price on a security or an equity. So if there's any difference, you're going to create noise.
Okay, I think you're real close here. That there could be disagreement, and that's going to generate potential predictability, and something even more fundamental. Inefficiency. What we've got is something we're able to somehow find something the market's missed. Okay? The inefficiency, very difficult kind of concept. I mentioned it before. It's hard to distinguish between other kind of stories. Okay? Because it might be that we've got disagreement in the market. We've got a number of different people in the market trading with different levels of skill. And I've got a lot of skill when it comes to these models. And what am I doing here? I am capturing a complex set of information in the market and synthesizing it in an optimal way. That's what a regression does. It takes these variables and puts them together in an optimal way. And then I'm using that to get the forecast of the return. And I'm basically saying that other people in the market cannot do this sort of thing in their head. Or they haven't stumbled upon the exact specification that I'm using in my assignment 3-like regressions. Okay, so you can attribute it to a range of different skill. And if you can consistently use this model, you can also attribute it to some degree of market inefficiency. Yes?
If there are 2 more people in the market with greater skill, they would make sure that any analysis I do ability to formulate strategies or get predictability, they are better predictor and they'll basically eat me alive. So you think, you know, by the same logic, like we are trying
Sorry,
to.
why would you trade, given that there's these people out there that have got the best possible predictability type of models? Well, the reason is simple, and I think the reason you discovered in assignment number 3, that the best possible model doesn't have a very high R squared. And your hit rate is like not 90%, it's much lower. So there will be people that will not be impressed with that, I guess. And there's a lot of people trading in the market just because they need to trade for liquidity. There's always going to be those traders out there too. But you're going to have the information traders, everybody running their models and trying to fine-tune their models. Okay? And not to make things too complicated here, but our predictive models, they assume constant coefficients too. They're not betas like in the explanatory model, right? They're predictive kind of models, so let's just call them coefficients. There's no reason that we can't do the same thing that I just showed you how to do for the dynamic beta model. So we can make our regression coefficients functions of other stuff. Again, put a t-1 on it, so it's predictive. A lot of the models in the market, and maybe you've seen this already in assignment number 3, you estimate a predictive model over 31 years of data. And you're assuming that the relationship between the instruments and the asset is the same over 31 years. That's not a reasonable assumption. Stuff changes. So again, you can improve your model. So maybe there's somebody out there who's got the right variables, but has fixed the coefficients. Then you've got the same variables, but you've got dynamic coefficients. And you're going to do better when it comes to trading. Now, for those of you that are traders, you know that you just can't go out and say, I got the best model and just buy huge positions. Or things will just go away. People will not trade with you. So you have to be sneaky. Sometimes take the wrong trades on purpose. But all of this has to do with kind of like dynamically looking at this whole process. That's the one thing that's really important when we talk about tactical asset allocation, that everything must be dynamic. The expected returns, the volatilities, the covariances, the skewness, whatever, everything is dynamic. It is, in my way of looking at it, naive to think that any of that is constant. Yet you open up standard textbooks in finance. You don't see any T subscript on a beta in the standard books. Nothing like that. And you look actually in the market, the amazing number of firms and services still are looking at basically the old paradigm. What I'm trying to push you towards is kind of a different, new paradigm with stuff changing through time. Don't need to be running neural nets or genetic algorithms to get your betas to change through time. It's a simple way to do it. And it's a simple way to test for the time variation in the beta. Just in that regression, I said test whether C2 is different from 0. It's a T ratio. That's it. Okay, so let's take a break and come back and finish this off.
we have to get together to do this.
Yeah,
It's possibly
absolutely.
worth more than 10.
Absolutely.
And we think someone's gonna pay 11 for it.
Yeah, so let's say there's an asset out there that's got like a negative 10%. It's got a negative data that's negative. Why?
But, you know,
It's hard to predict when it's not.
Right. So can you distinguish between a student's preference on the parent stock and gold stock or something like that? I mean, every once in a while you get a spike in the price of gold. Some people buy gold thinking that might get a spike. Sorry about it. good idea.
Got that. Okay. Sorry about that. We have very good. Both of you?
Okay, let's get started. Had a couple of interesting questions at the break that I want to share with you. The first question had to do with that graph that I showed of the betas and the expected returns and kind of no relationship between the betas and the expected return. And I said, well, that's what the CAPM looks like if we take it to the data. Okay? And I think there's a confusion because if you look in the textbooks, you don't see that graph. Indeed, you see a straight line with a positive slope. Okay? What I showed you is what the data actually looks like. What often appears in the textbook is what the data is supposed to look like, according to the theory. Okay? So if you actually look at the data, there's no significant relation between the fixed beta and the expected return. Okay? And one of the things that I handed out last time that I've got up here is one of these regressions. And the slope, this is just think of this as a regression of expected returns on beta. And notice that the slope is 0.15. The t ratio underneath that, if you can't see it, is 0.46. Okay, that's not significantly different from 0. Okay, so that's just an example of kind of like a modern, this is from a Fama French paper where there's really nothing there. Okay? And we need to do something about that in order to actually use these models. Okay, so let me just go into a little detail there. How are we going to use these models? Well, if we're doing any sort of risk analysis of a portfolio, we need to use a framework like this. So we've got a portfolio set of weights. We need to know what the exposures are to various different economic factors. Okay? We need to know what the beta of the portfolio is. But that's only meaningful if we've got a model that makes sense. And what I showed you initially was that graph just looked like a blob of points, or it didn't look like there was any difference between a stock that had a beta 0 and a stock that had a beta 5. So we actually need some model to actually help us with that. These models have got a number of other uses that are very important. I remember I presented at a conference in Zurich. That was about 4 years ago. It was just after Fama and French got all this press in The Economist with their claim that the CAPM was dead. Again, basically pointing to that T statistic, saying 0.46, not good enough. Okay, and they got other stuff in their model that's got a T ratio of 3. Okay, so I'm there, and there's maybe 150 people there, that, well, I won't say they're in a panic, but the level of stress was very high because all of the performance evaluation models were somehow tied to a CAPM-like model. And now, Baum and French come out and say, well, you know, we really can't distinguish performance based upon the beta. So look at all these models that have taken years to implement. And all of a sudden, somebody's saying these models aren't any good. Okay, so performance evaluation is a really big deal. Okay, we need some sort of theory to help us with that, because if there's no theory, then people will take potentially very risky positions to earn a higher expected return. We need to basically make sure that doesn't happen, okay, if we're evaluating. The other thing that I should mention is more practical application of these beta models, and it has to do with hedging. Now, some of you maybe have done the derivatives course, and sometimes what you do is to figure out what the hedge ratio is, to hedge a particular security, for example. Okay. And I'm not sure you've actually done this, but often what you will do is run a regression. You've got a particular portfolio of treasury bonds, let's say, and you're going to hedge that with, let's say, the CBOT longer treasury contract. You take your historical returns, regress on the returns in the futures, you get a beta, and the beta tells you what the hedge ratio is. Okay? In this simple example, I kept it to treasury bonds. There's a relationship between the beta and the modified duration, right? It's really what it's representing. Modified duration being the sensitivity of your bond portfolio return to a 1% change in interest rates. Okay, so people use these regression models all the time to figure out what the hedge ratio is, and the beta is just a hedge ratio there, or in this context, it's going to tell you how many contracts you need to short to hedge your portfolio of bonds. Okay, well, let's think about this a little more. Do you do modified duration in the intro course anymore? No? Somebody knows it, but tell me, is modified duration a function of any kind of known economic variable? Interest rates. Right? Interest rates make a big difference. Okay, so high interest rate environment and a low interest rate environment will change the sensitivity of a bond to a change in the interest rates. Sensitivity, it's a nonlinear function. It looks like this. Okay, so if you're using a simple regression with a constant coefficient, in that example, it doesn't make any sense, because the beta coefficient is going to be a function of the interest rate. And we could use this example for many other situations in hedging. So, and it doesn't have to be just a single simple regression. It could be that you're hedging, let's say, a portfolio of junk bonds. Okay, how would you set up the hedge ratio for that? Okay, a portfolio of junk. You want to hedge it in the short term. Ideas? You can use a regression, right? We're going to try to find portfolio weights that kind of mimic our junk bond returns. It's going to be contemporaneous regression. And what's going to drive the value of the junk bonds? Interest rates? Yeah. Okay, so one of our things in our regression will probably be the longer bond futures, a return in there. What else drives junk versus treasuries? Yeah, just what's happening in the equity market. Like junk is like equity in a way. So we put a second thing in there, the the S&P 500 futures. You run a regression, you try to get the maximal R squared, which tells us something about the fit of the model, your ability to hedge. You take a look at the betas in that regression, and you use those directly to set up a hedge position. Okay. Now, that particular example I gave you of the junk bond regressed on the T-bond futures and the S&P 500 futures, I'll tell you right now that those betas change through time. Okay? Really big. Okay, especially in times of kind of economic slowdown, then the loading on the S&P 500 becomes very significant. Okay? Where they behave more and more like equities. So here's another example of how we could use a dynamic beta model. So we've got maybe 3 or 4 different applications of this. It's a simple way to get hedge ratios that change through time. And again, you can plot that beta function, and you can forecast it at the next period, and that's exactly the sort of hedging position you should put on. Okay. Now, the second question at the break is not exactly related to this, but it's similar in that it really gets us to think about asset pricing models and what they mean. Okay. And the question had to do with that we talked about skewness last time, and it seemed extraordinary that people would buy something for a price knowing that the expected return was so low or negative. So you buy a lottery ticket for 48 cents, or you buy it for $1 knowing that you're going to get 48 cents. So why would you pay $1 when you know that you're going to get 48 cents? How does that make sense? Well, could there ever be a situation where you're buying something where you expect the return to actually be negative? And I said in response, well, this is just because people have a preference for skewness. They like that skewness. Okay, and that's somewhat confusing in that people are locking in a negative expected return. Well, let's put it another way. We don't need any preference for skewness to figure out that some people would be willing to take a negative expected return on an asset. So we're simply in a mean variance traditional type of world. Maybe the CAPM even works. What's a scenario where you would take a negative expected return? Who would knowingly buy an asset, okay, knowingly realizing that the price next period is going to be lower than what you paid for it? Does that make any sense? Yes?
You could do it to reduce the volatility of the overall portfolio.
Exactly. So it has to do with the hedging property of that asset. Right? So you would accept, potentially, okay, not for sure, potentially you would accept an asset with a negative expected return if it greatly reduced the variance of your portfolio. And what does that mean in terms of CAPM? What's the beta? It's negative, right? So something with a negative beta is going to have a sufficiently large negative beta is going to have a negative expected return. And the only logical reason that you would do this is the theory says that when you add this to the portfolio, it's going to reduce your volatility. Now, you might say, well, there's not that many stocks with negative betas out there, right? How's the easy way to get a negative beta position? Short. Anytime you short, you're putting a negative beta on. Now, it might not be for diversification purposes, but it is true if you continue to short the market, the expected return is negative. So people all the time do stuff that has got a negative expected return. You buy insurance. That's like a negative expected return.
Sure.
Okay? So and the skewness story is very similar in that why would people accept a low expected return for the lottery ticket? Well, because this is adding something to their portfolio, adding some positive skewness. Just like we talked about the negative expected return in the world of the CAPM, because of reduced variance. So just operating on different things. Yes?
In the insurance example and even in the lottery example, you might have an expected return that's negative, but there is a possibility of a positive actual return, right?
Insurance, I guess I'm not quite sure. If it's a simple insurance policy,
right, you pay
you're
the
just like paying
premium
for the downside, right? You're paying a
Right.
premium for the downside, right? And if there's a disaster, then you get paid off, right? So you're just kind of eliminating downside.
Okay,
Right.
but what about in a situation where there's no actual positive, there's no possibility of an actual positive return? In other words, the fire comes, it burns down your house, and the insurance company is not going to pay. So then, that's really the question I had, was where you know there's no upside at all, would you take that risk just to reduce your volatility? I mean, it seems like you're just taking money out of your pocket and burning it because you want to reduce your volatility. Is that
Yeah,
really?
but people like to reduce volatility. Then that's my point. That you have a preference over volatility. You don't like volatility. You don't like negative skewness. And people will, as evidenced by the size of the insurance market, they will go and try to eliminate that downside. So, and it's basically you're paying the premium, which is like a negative expected return. Okay, now I think that's maybe a little different than the example we've been talking about with the negative beta stock, where even though it's got a negative beta, there's a possibility of a big positive return, right? Whereas this is a little cleaner, your insurance example, where you're just like truncating a tail. But it's the same idea that what we're doing is trying to explain things in terms of preference for expected return variance and, in this case, skew. Okay, this is where asset pricing theory is important. Okay? Okay, let's continue on with this material because we got still a fair bit to do and a couple of topics that I want to take care of. Okay, but let's talk about efficiency and predictability a little bit. Gonna unzoom. Okay, so a lot of what we're going to talk about has to do with this notion of inefficiency and predictability. Okay, and I said in the very first lecture, I think, that it's possible to have predictability in an efficient market. Okay? As risk evolves through time, as those beta functions are evolving through time, and people can kind of observe that, as risk premia change through time. And I've got a great graph that I didn't actually bring of the risk premia changing through time, where it is really clear that there's a business cycle relationship between the risk premia and it looks like the premia is highest in recession and lowest at the peak of the expansion. So premia changing and beta changing can induce some predictability. Those two things together can induce predictability. Okay, and one thing that we need to understand is kind of a difficult concept here. I've pitched the asset pricing theory as telling us something about the cross-section of returns. So we generate our predictability in terms of assignment number 3. Then the asset pricing model will tell us, given the conditional risk of each of our assets, it'll help us explain why the prediction for asset 1 is greater than the prediction for asset 2. Okay? So the main part of asset pricing theory relates to explaining across different assets. The other part can actually help us understand the raw predictability that you see in assignment number 3, asset by asset. Okay. So if we have a model of the beta changing through time, if we have a model of the risk premia changing through time, that will induce predictability in the time series of a particular asset's return. Okay? And maybe the paper that I'm best known for is called The Variation of Economic Risk Premiums, published in the journal Political Economy in 1991. It's basically what I did with my co-author Wayne Fersen. What we did is took a look at the raw predictability from your assignment number 3. And then we modeled a beta changing through time, and we modeled a risk premium changing through time. Then basically took a look, plotted them. You can think of this. So our raw predictability generates returns like this through time. If there's no predictability, straight line. Expected returns are constant. And then what we did is we generated with the beta and with the risk premium a similar plot. Kind of the asset pricing models expected return with dynamic risk and risk premiums. And we noticed that there was a lot of coherence between what the asset pricing model was telling us and what we find in assignment number 3. And basically, we tried to make the case that our evidence was in favor of some of the predictability in the returns being generated via kind of rational asset pricing behavior. At the time, there was quite a controversy because people were taking the position that any predictability in the returns was due to market inefficiency. Indeed, stories of animal spirits, irrationality, stuff like this, it was just papers were suggesting this is pure irrationality in the market. Where I came in, basically we said we can never settle this argument. But what we can do is to say, well, is there any predictability that would be expected given that we know the risk dynamically evolves through time and we know the risk premiums have a business cycle pattern? And we found that some of the predictability could be accounted for by shifting risk and expected returns, but not all of it. And that's where we started the lecture with today. So some of this can be explained, some of it can't. Okay. And as asset managers, we need to realize that there's some limitations to what we can do. Okay, so there's a part that can be explained with shifting risk and shifting risk premiums. It is possible we can run some money just on that because the market hasn't figured out yet completely what those models look like. There's some disagreement over those models. But our real skill is going to come in what we call extra market timing. And what's that? I've got a paper with John Graham in the Journal of Financial Economics in 1996 on performance evaluation. And what we do is we have a simple model of timing the S&P 500 and cash. Just like what you're doing in assignment number 3 in kind of that euro-dollar swapping example. So we're just forecasting the S&P 500, and if it's greater than the T-bill, you're in the S&P 500. If it's less than the T-bill, you're in cash. Okay. And what we do is we say, well, we're evaluating people that are making recommendations on the mix between the S&P 500 and cash. Investment newsletters. Okay, just market timing, pure market timing. We've got like 400 of them. So we say, well, suppose that you had the benefit of the model in assignment number 3. And we call that kind of like the benchmark level of predictability. You actually go and look at the swapping between the S&P 500 and cash that's implied by that model. A model that anybody could run based upon the information that you've already looked through. And then we actually look at the performance of these newsletter timing strategies relative to that. Okay, so if what we call the market expected return is positive, and the market would suggest that you go into the S&P 500. Yet the recommendation is get out of the S&P 500 and go into cash, and the realization is also negative, then we say that these people have extra market timing ability. So there's kind of a benchmark market timing based upon your regression model, and then we actually see if they can do better than that. It goes the other way also. So you predict a negative excess return with the overall market model, and then it would suggest going into cash if they went into the S&P 500 at that time, and subsequently the market went up. That's extra market timing. So you can kind of divide this up in terms of kind of a benchmark, which might be implied by asset pricing theory, and then some skill on top of that, some extra market timing skill. That's basically what we're trying to do in tactical asset allocation. The problem is that we don't know how much of our predictability is kind of factored in by our competitors. And in a way, it might be an interesting academic question to try to divide that up. For us, we really don't care. Okay, we're going to use that predictability in the best possible way to try to get the best possible forecast and the best possible asset allocation. You need to be aware of kind of these stories as to what's happening. So why is there predictability? Like anybody can, go take a course in forecasting and run some predictive model. And that's not what's happening in this course. You might have had a course in forecasting, and some of you didn't. But I want you to think about the economic variables that go into a model like this, which you already have done. And then I want you to be able to interpret the predictions in terms of the theory that we know. Okay? And one thing we always need to take into account is this idea of risk. And risk can only really be grappled within the context of some sort of theory. And we spend a lot of time in finance talking about the capital asset pricing model. Yet I show you that the t statistic on the beta is 0.46. So what's the deal? It's in all the textbooks. Well, it's an elegant theory that helps us kind of explain a complex world. And it might be a theory that has a huge amount of merit, yet when we take it to the data, we do kind of the wrong things to the data. So we don't give the theory the best possible shot. Okay, so now what I would like to do is to talk about attributes and asset pricing. Okay, and this is some evidence, some recent evidence that has caused a big stir in terms of sort of stuff that we do. And then I want to talk about how to put this together in terms of market timing strategies. So let me put this graph up again. This is extraordinarily difficult to see, but again, I'm going to have to zoom in on it. This is from the Fama and French paper, 0.46 T ratio on the beta. And what they're trying to do is to explain the average returns on a number of different portfolios. And what they noticed was that if they put not just the beta in there, but they put the log of the market value of the equity, that came in very significant right here, T ratio 3.41. And the beta actually goes negative. The traditional CAPM beta goes negative. Okay? And then when they put the book to market ratio, the T ratio is enormous, 5. Okay, and then they've tried some other stuff over here. But basically, notice as you kind of like march down this column, they don't even try the beta anymore because it's gone. They don't even report how beta does against some of these other combinations. So what they're doing is explaining the cross-section of expected returns, and they find that the beta just doesn't come in. Okay? Now, I've talked about this model in the last lecture, and you know that there's some issues, right? So, issues. And number one issue is the constant beta assumption. Number two are the portfolios. Number three, whoops, let's unzoom. Someone's got to tell me what to do. Portfolios. And number three, what was the third issue? Portfolios, constant beta. Oh, yeah, the economic interpretation. Okay. Let me address this in a way that hopefully will link what we did in the first part of the lecture to right now. So you can think of the Froment-French model, and you can think of these people that are studying attributes in asset pricing in the following way. In the usual asset pricing model, we're trying to explain the returns on different assets with risk. Okay, that's fundamental. And in the capital asset pricing model, the risk is assumed to be the beta. So trying to explain, like that graph that I showed you, you plot the expected returns against the beta. See if there's a positive relation. When we go to more variables, it's difficult to do that in the graphing at least. It's the same idea. It's like a regression. Can the betas predict the returns? Explain the returns. Now, what some people have done is to say, well, I want to explain the cross-section of returns, so I can put other variables in there that are related to kind of fundamental data of the firm. So that regression I just showed you had the lagged market value of the firm, or the market to book sort of ratio is in there, and some other stuff, earnings price ratios also. So you can actually put this stuff into the model, and then take a look to see if this model can explain why returns are different across different securities. Now, the problem here is within the context of theory, we have to take this leap of faith that these attributes, these firm-specific coefficients or data, are exactly risk. That's what it means. So within the context of asset pricing, these attributes must be related to risk. Yet there's models out there called attribute or characteristic-based models that are regressing the returns on kind of lagged attributes of the firm. Okay, so how can we interpret this within the context of asset pricing? This actually, it's good to talk about this now, because next week, when we start doing selection, we're going to be pursuing these characteristic-based models. And maybe some of you have done this already in your evaluation course, where you're trying to predict the cross-section, which stocks are going to be winners, which are going to be losers, using attributes. Okay. Now, what I want to do today is to narrow that to the context of asset pricing theory. So, does this make sense? I'm going to write a simple model up and kind of show you what happens. And it's going to be very consistent with our dynamic beta model. And hopefully you'll see that it all makes sense. I've done my job. OK, so basically what happens if we're looking across different securities, we've got this model where expected return, so this is equals some coefficient times the beta. Okay? That's a kind of a cross-sectional regression. Right? So that's what we saw with the Fama French table that I put up there. They're actually using the beta. Okay? Using the beta in a cross-sectional regression. Now, what happens if you drop in the price-to-book ratio in that type of regression? Well, we saw that it came in with a t-ratio of 5. So significant explanatory power. Okay? And the only way for that to make sense, so expected returns here, we could hypothesize are going to be some function of beta and book to market. And the regression that we already saw suggested that book to market is very important. Now, how can we reconcile that finding with kind of traditional asset pricing? And this is the idea that I pursued in my research. The Fama and French specification assumes that the beta is constant. Suppose that's not a good assumption, that the beta is changing through time. And also suppose that the beta is changing through time and the changes are related to the book-to-market ratio for the individual firm. You know, book-to-market, you could tell a number of stories about that in terms of being related to distress. Well, distress to me is risk. So you put the beta in constant. It doesn't load in to the regression. You see no relation between the CAPM beta, the fixed beta, and the expected returns. You just put the book to market in there, so each firm's book to market, and it looks very significant. So the story that I've tried to tell and to investigate with my research is that this could be due to assuming that the beta is constant when really the beta is dynamic. And the beta is being impacted by the book-to-market ratio. Okay, so what are we going to do here? How do we get the beta? How do we test this theory first? How do we get the beta to be a function of the book-to-market ratio? It's what we did at the beginning. Right? I wrote down this model with IT minus 1. Well, you could do the same thing with the book-to-market ratio. So we could have, in our usual model, we've got R IT equals alpha I plus beta RM, or F1 if you want to call it that, plus E. Well, we can make the assumption that beta IT equals C0I plus C1I book to market T minus 1 for I. Okay. And we can estimate the regression just like we did in the first part. RIT equals alpha I plus C0I times RM, this is just the market, plus C1I RMT book to market at T minus 1. And we've got some error term here. Let's call it ET. This is identical to what I wrote out before. Everybody see that? Identical. Except now what I've done is that I've allowed the beta to be a function of the book to market ratio. So what you can think of doing here is to redo that regression with the 0.46 on the beta and the T ratio of 5 on the book to market. This time, you put in the beta that is evolving with the book to market, and it turns out that it comes in very significantly. And one more thing. That if you put in the book to market just as a raw variable, it doesn't load in with a T ratio of 5. It comes in less than 2. Okay, a couple of questions.
Well, don't you then have your C0 RMT? Isn't that analogous to the old beta?
Yes.
Which would then likely have a low T ratio for C0?
Yeah, but what is the beta now? That's the question.
But I mean, if you look at the T stat for C0I?
Yes. Remember, this is a regression firm by firm, right? And we know firm by firm, if we run the stock for some asset against the market, the C0 is going to be highly significant, right? Okay. So what you kind of like got to look at the time series and the cross section here. So what I'm going to do is I'm going to pick this off and put it into the cross sectional regression. Okay. There was another question?
Yeah, okay.
Yes.
I understand the theory that you explained, but I'm just confused as to when you run the second regression, the middle formula to get the beta regression. To run that regression, you've got to have the time series, and I'm just not seeing this leap. You've got to have the time series of the betas. Now, beta IT in the first formula is just your constant beta that we're arguing is not correct. It needs to be dynamic. Where are you getting the dynamic, each time period betas to run that second regression?
Okay, so do you agree that we could run the second regression, let's say, over 31 years of data? For an individual asset.
You need, if you're doing over 30 years of data, you need 360 or whatever betas,
yes.
Individual betas.
No, all I'm doing is, let's say this is some portfolio, like smallest size, smallest book to market portfolio. And I've got, let's say, 360 monthly returns. Right. Okay? And I'm going to regress that on the market, where I've got 360 returns. And I'm going to regress it on the market multiplied by the book to market, this lag. Now I've got 360 of those variables. Okay?
I see. Now I understand why you fed it into why you developed the second. Because you actually don't run the middle regression.
I can't.
Yeah,
this is just an assumption.
Yeah, that's what I was trying to figure out. How do you run that
that's
regression?
really important. So all I'm doing here is dumping that in here. This is assumption.
Right.
Okay, and I can generate this. I can generate 360 betas with this from this regression down here. Okay? So when I do that, when I make the beta dynamic, this is really important. When I make the beta dynamic, all of a sudden, the model has a better chance of working. And when you dump in a characteristic or an attribute, it doesn't come in with the same significance. Okay? Now, again, this might seem like highly theoretical and maybe of limited interest, but there is something here that is really important for asset management. It's very important, and let me try to get to it. Okay, and it has to. And we're getting real close to getting into stock selection, and it's very much related to it. There's a lot of practitioner models that are running attribute-based models. Let me just rewrite this last equation at the top of the page. So RIT equals alpha I plus C0I, and we'll call it factor if we want, FT, plus C1 FT times book to market t minus 1 for I plus some error. It's got an I on it also. Okay. Let's just file that right here. There's a lot of practitioner models, which I'll call characteristic or attribute-based models, where we try to explain the cross-section of returns. So we're trying to pick the winners from the losers. So cross-sectionally, we're regressing the returns on many different assets at a point in time. Okay, so this could be the returns on 1,000 assets in January 2001. And we're going to regress on attributes that are available the month before. So let's say we put the book to market at t minus 1 as a variable. So this would be available in December. That's going to be in our regression. And let's put, let's call them D0 plus D1. And we also have an error. Okay, now the usual model has got a lot of variables in it. So it's got book to market and a whole host of other variables in it. Okay, at one point in time, we're regressing on lagged attributes, trying to figure out the fitted values from this regression are going to tell us the expected, something about what's expected. Okay, see how to use this in practice? Let's say I estimate this, I get a D0 and a D1. Then I feed it the January book to markets, and I get a forecast of 1,000 different returns for February 2001. Do you see what's happening here? So I've got 1,000 different firms' returns in January 2001. I regress on 1,000 different firms' book to market in December 2000. Sorry. December 2000. Okay. If this is a significant variable, then I use it for an out-of-sample forecast for February 2001. Everybody get it? It's a little different than we're used to. In assignment number 3, everything is time series. Now what I'm talking about doing is looking across different firms. January returns on December's price to books. You get fitted values, and then basically when you do your out-of-sample, you can figure out the ones that are expected to do the best, the ones that are expected to do the worst. And this is kind of the basis of a long-short strategy, where you buy the ones that are right in the very top, you sell the ones that are at the very bottom. Okay? Yes?
Do you find there's varying degrees of significance between the assets? And how do you
Remember, these coefficients are the same. Right? It's a single coefficient. Just think of this as kind of inverting what you do in assignment number 3. We've got a column with 1,000 different returns for January for 1,000 different firms, and another column that's got the book to markets for each individual firm, and just run a regression. And I get 2 coefficients, an intercept and a slope. We could generalize this and have 39 more coefficients, as, for example, some of the practical models actually do. But for this presentation, let's keep it simple. Feed in the January price to books, and I get a forecasted February return for each of the 1,000 firms. Okay? Now, a practical problem here, and this model is not based upon any theory, it's a statistical model. A practical problem is that people have noticed that when you run this regression, let's say for January against December's data, and you estimate the D0 and the D1, and then let's say you step back a month and try to estimate it on December 2001, or December 2000 against November 2000. So another regression would be December 2000 versus November attribute. And you just keep on doing this back in time to test the model. But one thing that you notice is that this D1 that you estimate tends to change each time you do this regression. And sometimes change very significantly. Sometimes it flips sign. Now tell me how a sign flip could affect our strategy. Think about how we're using this model. We estimate it, and it's a positive relation, let's say, and we estimate in January 2001. Okay, we get a positive relation. And then we observe the January 2001 book to markets. Okay, we multiply those by D1, add D0, and we get expected returns for February. Okay, which basically means we're going to be buying the ones with the highest book to market and selling the ones with the lowest book to market. Right? Suppose we experience a sign flip. What happened to our strategy? We did the wrong thing. We bought what we should have sold and sold what we should have bought. It's a disaster. So what do we do about this? Well, there's a couple of things that people do. One is you just average these D1s. So every month you estimate, right, and you just have an average. Is that going to help us in our out-of-sample month? No. We're still doing the wrong thing. But it provides a smooth D1. It's smooth, but it's got to be smooth if you're putting a moving average on them, right? It doesn't really address the problem. Let me kind of give you my insight on this. Go back up here. If we kind of ignored this part here, this regression kind of looks like this regression, except what I've done is just assume that equals D1. This is telling me why the D1 is not stable. And what are the reasons? Well, with expectations on this factor, if this is the market, then just as the market premium changes through time, it's going to drive differences in the D1. But there's something more serious. C1 with an I subscript on it. What that's saying is that the true regression coefficient is specific to the individual firm. And that's a real problem. Because in this regression, I've got 1,000 assets, 1,000 book to markets, and 2 coefficients. If I assume the sensitivity to the book to market is firm specific, I need to add 999 additional coefficients. And you can't do that. So the theory suggests that this regression is misspecified, that we are forcing a common coefficient that we know will change with kind of market forces through time, and we also know that this coefficient is related to what's happening within the firm. Two reasons why this model is misspecified. Now, what are we going to do? So how can we actually get around this? Okay. And basically, what you can think of doing is trying to adjust the book-to-market ratio some way to kind of get rid of the firm-specific variation. Like you probably heard this, that, well, some of these financial ratios mean different things for different firms. Or the financial ratio means something different for a firm in one industry versus another industry. Yeah, I've heard stories like that. Well, is there a way to adjust the ratio to get rid of this firm-specific sensitivities? And there is. The way to do it is this regression right at the very top. So regress, let me write it. RIT for individual asset I equals alpha I plus, let's say we're using the market now again, RMT plus C1 I RMT book to market T minus 1 I plus my error. Run this regression firm by firm. Capture the C1I for each firm. 3, create an adjusted book to market. And the adjustment is going to equal book to market star T minus 1 equals the old book to market multiplied by C1I. Number 3, or number 4, run attribute model. Okay, and when we run that model, it's going to look like returns for 1,000 firms in January 2001 on book to market adjusted at T minus 1, available in December 2000. Okay, so what I've done here, okay, if you just run these attribute regressions to try to pick out the winners and the losers, you simply run it on the attribute itself, then it's just not going to work. Okay, because it's going to be unstable, and the true coefficient should be specific to the individual firm. So we somehow have to put the price to book, the book to market, PE, whatever ratio you're using, you have to put them on the same footing across different firms. And what I call this is optimal attribute adjustment for cross-sectional prediction models. And this falls right out of the theory. And that's, one of the most important insights here. That we can be running these attribute models. We notice that we've got instability through time. We've got specification errors across industry. You try to patch some of this with industry dummies, but it's only a patch. It's a Band-Aid. Really what we're talking about is these attributes reveal information about risk. And we can use the theory in a very simple way to make adjustments in the attributes. Okay, so what do you think happens? So we take the old regression that we had, where we regress the January 2001 returns on the December price to books. And then we compare that to a regression, the January 2001 returns on the optimally adjusted attribute, the book to market. The second regression is more stable. It's better specified. It's got higher predictability. And with higher predictability, we've got the chance of actually using something like this in a trading strategy. Okay? So this is kind of like where we jump to stock selection, because really, we're talking about it already. I got 1,000 firms in this regression. So what we need to do, and what we'll pick up on Monday, is kind of, I'll tie some loose ends on this and maybe go through a few things redundantly, because we did a lot of stuff today. Just like I did today, some stuff that I did last Thursday. Okay, so I'll tie up some loose ends here, but then we're actually going to go and see how to use a model like this to select winners and to short losers. Long short, that's what it's all about. Okay?